Going through your calls, there's not a great deal of optimism to be found. Basically, overall, you're actually seeing, despite the fact that investors continue to trade on a hope and a prayer on a slowdown from the Fed and then a pause, you think there's much more downside to come?
Absolutely. I think this is more of a bear market rally that we are seeing in equities based on hopes that Fed will pause and inflation will come down meaningfully. Although the trend is clear that inflation is going to fall in the coming months and quarters, but we are not going to see inflation coming down to 2% anytime soon. That would mean Fed will still hike rates to close to 5% in the first quarter of next year, and that's not good for risky assets. That's why we are underweight on equities, commodities, and emerging market FX.
Your underweight in equity seems to be a broad one, but over the past few months, we've seen, the FOMO trade, the TINA trade, the CITA trade, that China is the alternative. On that last one, would it change your allocations if we see an exit out of COVID zero?
Yes, if China decides to exit out of COVID zero, then definitely it would change our view. But at the current level, although there are some signals that China is adopting a more flexible approach, but the official commentary remains that China will adhere to its zero COVID policy. And on top of this, don't forget that the economy is extremely weak, and we have not seen any kind of further stimulus measures being announced by the authorities. So as long as you have the zero COVID policy approach, weak property market, and no further stimulus, we think it's quite likely that market again goes down.
We have seen from PIMCO also calling that if we do see a recession, we're actually seeing bonds act as a diversifier. Where do you stand there?
So we have a neutral view on bonds, but definitely compared to the equity market, bonds look more attractive as market has already priced in the US terminal interest rate of around 5%. So we think going forward in the next few months and quarters, investors should start building their bond portfolio for the next few years. Especially if you look at the investment grade bonds, now they are yielding close to 5.5%, which we have not seen in the last few years. And even some of the riskier assets in the bond market, for example, the emerging market hard currency bonds are now yielding more than 9%. So we think from a risk reward perspective, bond market look more attractive compared to the equity market.
How much are you factoring in geopolitical tensions, both around Ukraine, but also between the US and China, perhaps a little bit more easing when it comes to those concerns these days?
Yeah, it seems like the tensions are dialing back. We have seen that in the commodity prices, where food or agriculture prices have come down quite substantially. And even the whatever has happened in the last 24 hours, we have seen market completely retrace back all those losses. So at this point of time, I don't think geopolitical tension is something to price in the market. Definitely, you have to keep an eye on. Some of the space or the markets which could be impacted would be looking at specific sectors like chips, which are coming under pressure because of the sanctions of chip exports to China. So that's one place, I think, where we need to focus more on the impact of geopolitical tension.
Suresh, when you take a look at 2023, you talk about echoes and ripples. Is that telling us that rather than having very strong convictions, we could just see more of the same and I guess the impact of what we've seen over the past year?
I think at least in the first quarter, you are going to see the ripple effect of whatever has happened in the market and the economy over the last 1 year. Because global economy is yet to feel the full impact of the interest rate hikes and the higher commodity prices. As I mentioned, we expect US rates to go up to 5% in the first quarter. So that will definitely weigh on the economic outlook. And then we could see some sort of vulnerability or volatility in the market in the first quarter of next year or the second quarter of next year. So I think the game is not over. We will definitely see more volatility in the next 6 months.
You've touched on the emerging market space a little bit earlier, but what do you think of the broader narrative right now that's starting to form that perhaps we could see the biggest opportunities there next year, given that they have been more resilient to the global economic crisis, geopolitical crisis than we previously thought that they could be?
I think the recovery in EM will depend on two factors. One will be the reopening in China, and second will be what happens with the US dollar. So recently, we have seen a very strong fall in the USD, which has supported the performance of EM equities and generally EM assets. I don't think dollar is going to weaken meaningfully from here because US will still hike rates to 5%, which means there will be very few economies in the world which will have higher interest rate than US in the next 1 or 2 years. When it comes to China reopening, I think it's going to be a very slow process. We expect a reopening to take place sometime in Q2. So that would mean it will take some time for the economy to recover, and that's not going to support the EM equities or FX in the short term. So for the next 3 to 6 months, we still see more downside in EM equities and EM FX.